one fear that every non-homeowner currently has, and what they repeat to themselves every day is, will I be a forever renter? This is something that sits with 35% of Americans, as today's economic world is creating what feels like an impossible obstacle to overcome. And that's the affordability lie. And if you've ever watched the movie Elf, Buddy walks into New York believing in Santa. Well, everyone around him says that's not real. Same city, same rules, completely different reality.
And that's exactly what we see with money and home ownership. You've got asset owners, the believers, and asset chasers, the non-believers. They live in the same economy, face the same rates, but experience completely different outcomes. Instead of asking, when will home ownership be affordable again? Believers ask, what do I need to change? What behaviors need to adjust to make this work for my situation?
Hey, because we can't change the world around us. Buddy didn't change New York, but we can change what we do inside of it.
And that fear doesn't come from desire. It comes from misinformation and years of being told, this isn't for you.
So in this episode, we're breaking the lie. Not with hype, not with hope, but with clarity. So buckle up, get ready for some real talk, and let's get you out of the lie they want you to believe. That homeownership is no longer affordable. It's time for you to find your inner buddy, to break free from the story they told you to follow. It's time to create your own story, one without limits, just like Buddy did. Because of the belief changes, behavior follows. And the first place that shows up is how you spend your money.
So, how much house can I actually afford, Manly? Break it down to me.
This is where the affordability lie really starts. People don't buy houses, they buy numbers. Numbers from calculators that don't know how you live or what you believe is even possible. The real issue isn't what the bank approves. It's how your money is being allocated today. Lifestyles get funded automatically. Homeownership gets whatever's left, if anything.
Yeah, and this is where believers separate themselves. Asset chasers wait for life to calm down. Asset owners restructure life so it fits. A calculator, yeah, it may tell you what you can afford, but belief determines whether you organize your life around it. This is about control, deciding where your money works harder instead of wondering why it disappears.
Hey, and we're not saying stop living your life. Buddy didn't stop being Buddy. We're saying redirect it, a small pivot away from frictionless spending and toward intentional homeownership.
Yeah, but even once people believe ownership could be possible, there's still a voice that stops them. And that voice usually sounds like credit.
You're a big boy. What's your name?
Paul.
And what can I
Paul,
get you for Christmas?
Don't tell him what you want. He's a liar.
Let the kid talk.
You disgust me. How can you live with yourself?
Just cool it, Zippy.
You sit on a throne of lies.
Look, I'm not kidding.
You're a fake.
I'm a fake?
Yes.
How'd you like to be dead? Huh? No, he's kidding.
You stink.
Let's talk about credit, misinformation, and why people just wait too long.
Another massive reason people stay stuck is credit. Not because it's bad, but because people believe it is. The internet has turned credit into the scarlet letter. One mistake, one student loan, and suddenly people think they're disqualified for life.
Yeah, believers look at credit differently. Credit isn't a judgment, it's a system. And systems can be learned, adjusted, and more importantly, improved. Most people, they don't need perfection. They just need clarity and a starting point.
The fix isn't waiting. It's clarity. Once you know what score you actually need, fear turns into movement.
And once belief replaces fear, which it will, the next excuse usually becomes, I don't have enough money up front.
I get more action in a week than you've had your entire life. I've got houses in LA, Paris, and Vail. Each one of them with a 70-inch plasma screen. So I suggest you wipe that stupid smile off your face before I come over there and smack it off. You feeling strong, my friend? Call me Elf one more time.
He's an angry elf.
Look at you! Ow!
So this is a question we get asked all the time. How much money do I really need up front for a mortgage?
Hey, the most expensive lie in real estate history. You need 20% down. That belief alone has kept more people renting than higher rates ever could.
Yeah, non-believers hear that and they stop in their tracks. But believers ask, what are my options? Same rules, different mindset, completely different outcome.
Down payment, closing costs, assistant, gift funds. These paths exist, but only you can see them if you believe homeownership is possible.
That's right, Manly. And once people finally understand this, everything leads to the thing everyone watches, and that's mortgage rates.
You ready? Let's go.
Speaking of rates, it's the Mortgage 101 rate prediction tracker time. Okay, let's recap the year's wild ride and where we're actually landing.
Absolutely. Here's the 2025 ride thus far. Same market, different moods. Starting in January, we were at 6.64. The feds were grumpy and it was up. February went up to 6.9. The CPI was hotter than the oven. March, it went down to 6.54. Banking scare rally really set the tone. April, it went sideways, 6.57. There was a lot of mixed signals, but May, we saw a tick up, not the right direction at 6.79 because of the debt ceiling drama. June, we saw 6.94, almost touching 7. It was the peak freeze. In July, it went down. We're going the right direction at 6.77 because the Fed paused. But then August was the highest year to date at 7.02 because of the oil and rent spike. September, we went down to 6.81. We've seen some growth worries. October, the biggest drop this year, 6.31% because of cooling inflation. November, we saw small mixed signals at 6.34, waiting on those cuts. And right now, early December, we're sitting around 6.36%. It's down, ticking lower every day. Manly, what you got?
Yeah, yep. That puts us a finishing touch on about our original call. We were at 6.36 versus 5.875 to 6.25 forecast. But zoom out, the story matters more than the numbers. We see this in early 2026 being right in the middle. It's going to be a slow thaw, no avalanche. Believers don't wait for perfect weather. They prepare for the seasons.
Yeah, and I will say a caveat. I mean, the big thing that no one's talking about, you know, the elephant in the room that's wearing a cloak, in my opinion, is Hassett. If Kevin Hassett gets in next year as the Fed chair, he is a massive proponent on expanding the balance sheet. And if he does expand the balance sheet, which for those of you out there is another term of maybe quantitative easing or printing of money, that signals lower rates. And Kevin is a big cheerleader when it comes to stimulating the economy through rate reduction. So, you know, I didn't think I would be saying this, but we could see potentially 4s within the next 15 to 24 months if Kevin has his way, because now we have everything aligned. We have the White House aligned with the feds. Now they're going in the same direction. There's none of this, we want rates lower versus rates higher for longer. We are not going to be getting these mixed signals anymore. I think this is going to be a big turning point. Time will only tell. I cannot wait till middle of this year, next year.
Yeah, yep. There's a lot of what ifs there, but if it does line up the way you're saying, I'm in agreement. We're going to see some interesting stuff, and we could see our whole, rate prediction tractor skewed dramatically because of the flavor of everybody being in alignment, which stop butting heads is an important important theme here. If we can stop butting heads, we've talked about that over and over again in our previous episodes. Like, stop.
Yeah, and
Stop.
those headbutts, that's creating volatility and uncertainty. And we know the market prices on the defense when it sees that. Once we no longer have that headwind and now things are in line and we're not going against the grain, I mean, you and I are probably going to make our rate tracker in the fives, right? Low to mid fives for next year on a good note. But if we go into the fours, that's going to be ridiculous. If people thought it was going to be a crazy market now, wait till you see that happening.
The one thing that you pointed out there, and we've talked about being very problematic episode after episode, is the lack of clarity or the fog because of the headbutting that's created. What you're talking about is clarity and the boat moving in the same direction. The tail of the boat and the front of the boat both going in one direction instead of fighting each other. That's going to be a big deal. Hopefully this is all going to work out and we're going to see some real movement and some real clarity coming forward.
I made 85.
85? That puts you 915 off the pace.
Why don't you just say it? I'm the worst toy maker in the world. I'm a cotton-headed ninny-muggins.
No, buddy, you're not a cotton-headed ninny-muggins. We all just have different talents, that's all.
Seems like everyone else has the same talents except for me.
Let's talk about buzzwords. That's the ones that come up when you're looking to buy a home.
That's right. For most buyers, it feels like Buddy walking into New York. Everyone assumes you know the rules, but no one explains them to you.
Goal here isn't to sound smart. It's to make sure you understand what these actually mean when real money is on the line. Ryan, you're up, brother.
All right, boys, keep it simple or the Central Park Rangers are getting involved. First term today, loan contingencies.
Yeah, that's a good one, right? That is the buyer's protection. That's the guardrails. They are for the buyer to ensure that their earnest deposit is safe and the transaction is running smoothly. You have contingencies like the loan approval, making sure you get the loan approved in a certain amount of time. You have appraisal contingencies to make sure the appraisal is in on time in the event that it comes in lower and you can negotiate. And then you have the final loan approval, making sure that everything's cleared off and it's clear to close. And then you have your closing contingency. When is this supposed to close? All of this points in the direction for the buyer to protect them, to make sure that they're not just giving away free money in the form of earnest deposit.
Very good. Speaking of earnest deposit, Manley, tell us about that.
So your earnest money deposit is a small token of appreciation towards your seller. You give a small part of your overall down payment and closing costs. So just making up a story here, if you're giving $100,000 down payment, you might give a $10,000 earnest money deposit to show the the seller that you're seriously interested in this property and you're putting that money up front and saying, I'm here to win.
Up next, Anthony, tell us about inspections versus appraisal.
Yeah, this one gets missed all the time as far as what the definition is. The inspection is completely optional in the eyes of the lender. We don't care about it. We don't need it. But it is definitely something that the buyer should be doing because an inspector is going to be looking with a fine-tooth comb. Are there any issues we can't see with the naked eye? Structural, plumbing, electrical, roof, all the stuff you can't see. You want to make sure you're not buying a big money pit. Whereas an appraisal is strictly for the valuation purpose and is mandatory unless you have an appraisal waiver. You need an appraisal, which looks at the value to make sure that you're buying and it's worth what you're buying it for. And a caveat to that is if there's any safety or habitable issues in the line of sight of the appraiser, he will call it out on the appraisal. So if they can see it, they may call it. In other words, if they go in and see a big, leak stain on the roof, they're going to say that may need to be checked out by a professional roofer. So keep in mind, even though they don't inspect granular, they do call stuff out that they see with their line of sight.
I want to add one little caveat to this as well and point out that that home inspection, again, is one of these really interesting items. It's supposed to tell you all the warts that are wrong with this property. The lender, by no way, shape, or form, should ever get his hands on that report, because if it gets entered into the whole contract the wrong way and the underwriter looks at it all, it could be very dangerous, because they could say, fix all the problems that this inspector, which he was trained to do, pick out all the warts, all the problems. You don't want that to happen. Please don't let that happen. Don't share that with your lender.
Yeah, and the inspection is not meant to scare the borrower. It's meant to basically put them in the know. A lot of times you see these and they're very lengthy, but they are like color coded, like back in 5th grade, where green is go, yellow is caution, and red is hold the horses. Same thing with that. You're always going to find something wrong, even with new builds. But what you're trying to mitigate here is the big ticket items. And you don't want even small ticket items to be shown to the lender, because that could be a massive hurdle for closing if the seller doesn't want to play. So definitely keep it optional, keep it out of your lender's hands, because we don't want to see it.
Yep. Sorry.
Yep. All good. All good. Up next, Manley, tell us about home warranties.
Ooh. Home warranties is a great item that you can put in place, especially after you just had an inspection report that's telling you about all the deferred maintenance that may be occurring, or that they don't really know the specific age of a furnace or the roof or appliances, that kind of things. It's a great product that's very inexpensive, usually costs somewhere between $500 to a couple $1,000 depending on the home, and it protects the buyer for the next year. Sometimes the sellers pay for it, sometimes the buyers pay for it. Doesn't matter. It's a great product to have.
Yeah, and for a caveat for that, just think of it as you have 3 types of insurance. You have mortgage insurance if you have less than 20% down. You have homeowner's insurance, which covers the house. Then you have warranty insurance, everything in the house. Hot water heater, like Manley said, garbage disposal, air conditioning. If it breaks, you pay a copay, they fix it, or they replace it. It's an insurance policy to make sure that, would you rather have a small amount per month or per year to stave off big ticket items later on? As a homeowner, it's definitely optional, but definitely warranted.
And finally today, Anthony, tell us about LTV.
LTV, loan to value, right? All these acronyms that you hear in our world. So loan to value is basically what you put down on the purchase price, then you minus that and you have your loan amount. So for instance, to keep math simple, $100,000 purchase price, you put $5,000 down, that's 95% loan to value, 95% of the purchase. So look at it as with FHA, you have 3.5% down, which is 96.5% loan to value. Conventional, minimum 3% down, 97% loan to value. Whereas our beautiful loans like USDA or VA, those are 100% loan to value because there's nothing down.
And remember, the best way to spread Christmas cheer is understanding your loan terms loud and clear.
Buddy, is that you? Are you okay? Boy, am I glad to see you. The clausometer suddenly just dropped down to 0. There's just no Christmas spirit anymore. The strain was too much. The engine broke free of her mounts. I need an elf's help.
I'm not an elf, Santa. I can't do anything right.
But he didn't change the city. He changed what he believed inside. Asset owners don't live in a better economy. They live with a different mindset.
Yeah, it's all about mindset, Manley. Beliefs drive behavior, and behavior creates assets, especially in home ownership.
Change what you believe is possible, and your actions will follow. And if this episode helped you shift your mindset even a little, I appreciate you. Thank you for spending your time with us.
That's right. And if you're watching this on YouTube, hit like and subscribe and comment your biggest myth about home ownership below.
And if you're listening on your favorite podcast app, make sure to follow the show. We read the comments, we build episodes from them, and we appreciate every single one of you. We'll see you on the next episode.
Santa Claus is coming to town.
Okay, Manly, you want to know a crazy, interesting fact?
What amazing factoid do you have for me today?
So I'm reading here on the news that it's pretty crazy that in Wisconsin, the Packers are the only publicly traded and owned NFL team, which means every single loss is technically a shareholder meeting.
By the way, I am a shareholder and a part owner of the Green Bay Packers. So you and your little tidbits of trying to pick on me about Wisconsin football teams and baseball teams, not going to happen because you don't even have a football team in Kauai.
We have a coconut team. That's basically it.
That is for sure. Thanks for watching. New factoids next week. If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or a topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.
Girl, from the heart of Wisconsin to the waves of Hawaii, Manly and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know with a little soul and a little homegrown flow. It's the Mortgage 101 podcast where real talk meets home at last. Manly's got that Midwest soul. Anthony brings that island roll when the market swings and you don't go fast. Tune in, the Mortgage 101.